Ironsides Macro's Barry Knapp says a hawkish Fed and the ongoing bond rout poses so much risk to banks, he's no longer recommending investors get into equities for a year-end rally. And he joins me now. Barry, it's good to see you again. Welcome.
Morning, Cal. Well, it's morning for me.
Yeah, well, I was going to comment on the snowy peaks behind you, but no, it appears you're not just talking about bank stocks either. You're talking about the market more broadly.
Yes. So my expectation was, up until the Fed meeting of last week, that we still were on path for a potential bull steepening of the curve driven by disinflation, right? So there's sort of three ways the curve can disinvert, and it absolutely needs to disinvert by the first half of next year, because we've got a crack up coming in multifamily real estate, the banking system, small businesses, the labor market. But of those three potential ways the curve can disinvert, the path we were on for most of this year, which was the reason I was so bullish, was because if the curve disinverts as a consequence of disinflation, of falling inflation, and the Fed decides, hey, it's working, let's just stop hiking and then perhaps even start cutting in the first half of next year as the banking system comes under increasing amounts of stress, we had a good chance of really having that benign outcome. If the curve disinverts, bull steepens because the economy really weakens, employment weakens, well, that will end the recovery in corporate earnings.
Right.
That's obviously a negative outcome. And that seems to be what the Fed now is dependent upon. That the meeting last week and the subsequent speeches all implied that Fed just thinks growth is too strong and needs to go down. It's as if they're saying they want earnings to go down, corporate earnings to go down further. And then, of course, there's the worst case scenario, the insidious bear steepening that we're in the midst of, which is just the back end selling off and long-term rates going above 5, which creates a whole myriad of other sets of problems.
Sure.
It's a risk off, stocks lose, bonds lose, everything loses.
A lot of people thought the opposite would happen, that as we get talking about the economy worsening, the long end would decline. And instead as you said, the most notable event of the week is the impulsive sell-off in the Treasury market. You know, some big name investors are starting to tell me that they might be thinking about buying here, and that in the long run, a slower economy will trump deficit concerns. Will that cap the haywire move in bond yields, do you think?
Well, that seems to me to be the only thing to stop the sell-off in the back end. The sell-off in the back end, 39 years of being in the markets, I only recall two periods where the market really backed up to absorb supply. That was from January 4th of 21, when the Republicans lost the Senate in the Georgia special runoffs, through the signing of the American Recovery Plan, the 1.9 fiscal stimulus, where 30-year real rates, the portion of the Treasury curve least affected by rate policy or the balance sheet, moved out 60 basis points just on a line. That same thing happened again in August and through the middle of this year. We're at about 75 basis points and counting. So this is a real sign that the U.S. is reaching its fiscal limit. Our ability to borrow is really limited by Janet Yellen losing all her best customers, right? She lost the Fed, who was her number one customer.
Right.
She lost the banking system that's now shedding treasuries to get ready for this coming storm in commercial real estate and multifamily in particular. And of course, she lost foreign buyers as well, particularly Asian buyers. And so this is a little bit of a warning sign that the policymakers haven't really picked up on. I mean,
no, and I think it's fascinating because, Barry, we're in the middle of this fight about the government shutdown. So, you know, an observer from Mars might think, oh, yes, there is a government shutdown fight because bond yields are going haywire and they have to pull back spending. But it's not really about that at all. I'm not sure there's going to be any spending changes here. And unfortunately, it looks like it would literally take a further bond route that pushed the stock market into a route to really change that course of action on the fiscal side.
Yeah, I couldn't agree more strongly. Congress is haggling about the 30% of spending, which is discretionary. After the deal that they did this summer, the CBO projections for the next 10 years barely moved. I mean, this is the only way to really get our debt on a sustainable path is through entitlement reform.